So, good morning, ladies and gentlemen. Welcome to Czech National Bank meeting with analysts. As every 3 months, we are going to present you our latest macroeconomic forecast, which was prepared by our colleagues from monetary section or department. Before we start, let me introduce you our today's speakers. Czech National Bank board member Mrs. Kubelková.
Morning.
Executive Director of Monetary Department, Mr. Sklenář.
Good morning.
And Deputy Director of Monetary Department, Jakub Matějů.
Good morning.
So, Jakub, floor is yours.
Thank you. Thanks a lot for coming, for the attention you give us, and let me present you our new forecast from the Monetary Policy Report Summer 26. As always, I will kick off with two charts which illustrate the highlights of our message, which we have conveyed to the board during the monetary policy the preparation for the monetary policy meeting. So first of all, although we have been somewhat downward surprised by the headline GDP numbers, by relatively weaker growth in first quarter and also by the flash estimate, domestic demand stays strong, stays supported by robust wage dynamics and good sentiment. Second, inflation is being held firm by the core component. Core inflation stays close to 3%, and the items which are mitigating or compensating the strong core are those non-core components which recently stagnate, but we shouldn't expect this to continue into next year. So this sticky core is something to look at and to consider very seriously, because we cannot rely on disinflation or deflation in food prices going forward into the next year. So I would say these are the two main streams of analysis and thought, that on one side the strength of domestic demand, and on the other side core inflation staying firm at close to 3%, and only the non-core volatile components helping to keep headline inflation low. But let's now move to the forecast itself. We do not publish in this round any scenarios. In the debate with the board, we concluded that the uncertainty and the arguments for producing alternative scenarios, specifically now at this moment, is relatively low, and that we do not want to produce scenarios only for producing scenarios. So we did not feel with the board the need to dilute the message we have in the baseline. So this also allows me to be relatively more brief and maybe to focus on some of the features, namely wages this time. After headline inflation at 2% this year, we expect acceleration to 2.5% in the next year, and inflation will stay in 28 above the target exclusively due to the ETS2 impact. Otherwise, it would be at 2.0. We estimate the ETS2 to have 0.4 impact on headline inflation. GDP, after 2.2 this year, we expect acceleration to 2.7, and then 2.5 in 28, consistent with our long-term steady-state potential growth. The flash estimate, which we did not know before finalizing the forecast, would mean minor downward risk to this forecast, shaving 1 decimal point in both 26 and 27 if we would be to do a mechanical update after seeing the flash GDP data. Average nominal wages, we have seen quite strong numbers at the start of this year. Therefore, we need to expect also elevated trajectory going forward, 7.3 this year, 5.7 next. The slowdown is relatively slow. The whole trajectory stays elevated for some more time. But I will get to that in a separate slide. Regarding rates, we see broad stability of rates going forward. Similarly for the Euro CZK exchange rate, we see stability around 24.3 in the next 2 years. What is very important was very important input to the forecast, also very volatile one, were commodity prices in the past month. We have seen again numbers close to 100 or at 100 USD per barrel, but these 2 weeks ago, roughly, when we were finalizing the forecast, we made back then we saw oil prices around 90 plus. We made a wild guess that it might be at 83 on average during third quarter. That the situation would calm down a little bit. And we were extremely lucky because this is exactly the price we see now this morning. So this evolves quite well and fulfills our forecast. Similarly, natural gas prices, which are around 55 euro per megawatt hour, and the prices are in line with our forecast for Q3. So no major deviations there so far. Regarding other parts of foreign environment outlook, we see German economy picking up growth rate to 0.8 this year and further to 1.2 in the next. Following from relatively strong numbers seen in the first and second quarter this year. For Slovakia, following relatively low growth rates in last year and this, we see acceleration in 27 and 28 to 2% and 2.6 respectively, with a contribution of the new Volvo factory, for example, but also end of the fiscal consolidation measures. The foreign rates, important assumption, we expect from the ECB one more hike during this year, and we also expect one hike from the Fed. So this is our assumption. It might deviate a little bit from the market pricing, where the ECB, I believe, it's still the pricing is a little bit more on the hawkish side than our assumption. Coming to inflation and inflation outlook, we expect the headline to accelerate somewhat in the rest of the year. First of all, the flash estimate came entirely in line with our expectations. So again, we are happy about that. No risk coming from the flash CPI. We expect some acceleration in the rest of the summer and September towards the end of the year, where we could get close to 3%, maybe even 3.0 at the break of the year, and then in 27, on average, we expect to see 2.5, and in 28, 2.4, as I already said, related to the impact of ETS2 introduction, which we still have as an assumption for 28. Yeah, then maybe I can jump to GDP growth, where the flash estimate came a little bit below our expectation. We expected 0.6 Q-on-Q growth rate. The flash was 0.4. For the next year, then we expect 2.7 as a whole year annual growth rate, and coming down to 2.5 in 2028. This weaker flash estimate would, as I think I'd already said, that would shave 1 decimal point both from this year and the next if we would do the mechanical update. GDP is expected to be driven mainly by household consumption and fixed investment in the following years. Household consumption follows from rapid growth in real wages. We expect consumption to grow 3.2 this year, similar rate next year, and then moderate somewhat to 2.3 in 28. There is a small technical issue with the fiscal impulse where the one-off increase in household consumption we expect to happen in Q3 as a result of methodological change, where the Czech Statistical Office reclassifies the housing allowances from government consumption to private consumption. So this change has net zero effect on the GDP numbers, but we need to reclassify from the government consumption to the fiscal impulse, and to which affects then household consumption. So the 0.4 is fiscal impulse is affected by this statistical effect. Still, we expect fiscal policy to have expansionary effect this year and roughly neutral in the following years. I would now stay a little bit with one detail of the wage data, because the previous slide was related to household consumption and how strong wage data translate to robust growth in domestic demand and especially household consumption. But let me add a grain of salt in our wage data readings. We have seen very strong Q1. The official number is 8.1, which would normally lead to us being relatively worried what is happening in wages if we see some reacceleration or acceleration above 8. But the upper chart shows let's say the difference between the first release of the wage data and the final data which we know now, or which we have from the statistical office now. So for the past 4 years the revisions were systematically downwards. So after the first release, always the final data shows around 1 percentage point lower wage levels. So this is an observation. It's a remarkably consistent one since 22. All revisions were downwards. Not all revisions were downwards, but the final number is always below the first release. And if we focus on the latest revision, it was related or driven mostly by the market services, which is also like that we can have a sectoral interpretation to the revisions. So maybe the data available to the Czech Statistical Office in the first release is relatively low quality in the sector of market services. They accumulate further information from that sector and revise downwards. So this is what we have been seeing during last years. The sectoral decomposition only relates to the latest release. So there are several messages which we draw from this. First of all, the first quarter 26 was not yet revised, so we can expect it to be revised, and the expected direction is downwards. Maybe 1 percentage point again, or this is speculation, but or forecast. So we can expect this number to be revised downwards, and Another lesson, the last one, that exposed the wage growth in market services appears to be more in line with that in industrial sectors. So this outperformance of wages in market services might not be that big as it appears in the real time. But let's get back to investment to GDP and GDP components. We see private investment to be driver of gross capital formation going forward. We've seen gaining momentum already last year. That in the second half of last year, the fixed investment was more and more driven by private investment. We saw this at the start of this year, and we expect it to continue to some degree. Net exports, or especially imports, strong imports were the cause of relatively weak growth in the first quarter, where import dynamic exceeded the exports. We were digging in what were the causes, because this is not very common, and we found out, maybe some of you also came to this conclusion, that what we see in the sectoral decomposition and in other decomposition, and is that imports were driven by car imports and maybe small utility car imports, and this was reflected also in the private investment acceleration, where we saw investment of the private sector in car parks, in car fleets, So we think that what happened was a coincidence in one quarter when many of companies renewed their car fleets. This also matches the import destinations. They came from Poland and Germany, where most of the smaller utility cars are produced and imported from. So this is some one-off factor, and also the flash estimate for the second quarter indicates that this might have reverted. The statistical office again speaks about positive import from net exports and doesn't mention fixed investment as a driver of growth. So we think that this has been reverted in the second quarter and is more of a one-off event, let's say. But that said, we still expect fixed investment to continue based on reviving or relatively robustly growing foreign demand, renewal growth in Germany, which we see happening now. Exchange rate. We expect a real rough stability around 24.3. Vis-a-vis the current levels around 24.2, this is a very mild weakening, but a very minor one, which relates to the negative net exports, and also some competitive cost disadvantage where the domestic producers face a relatively strong wage growth relative to the foreign producers. So these are minor reasons for the very mild weakening you might see on the forecast. Regarding the rates trajectory, we see roughly broadly stable rates going forward, with a very mild increase towards 4% before again coming down to levels which we have now. The decomposition is also we are speaking about contributions of 1%, 1 decimal point maximum. Initial conditions point slightly towards higher rates, where the wage dynamics, although we discount the surprise somewhat, still the wages are going strong. Even if we would be to expect a revision, still growth rate around 7% would be strong. So this overweights the downward surprise from the GDP releases. Foreign environment, we see stronger price pressures from higher energy prices compared to the previous forecast, and also still somewhat higher outlook for the euro and US rates. On the other hand, the near-term forecast of inflation and administered prices inflation contributes to slightly lower rates outlook on the very short term. Also, the fact that let's say that the decisions taken were not did not fully fulfill the interest rate trajectory, contributes to the downward revision on the very near end of the curve. Let me now summarize or end with this table again, so you all have it in front of you, and we'll be happy to take your questions.
So thank you for the presentation. So let's move to your questions. Remember to activate your microphone and briefly introduce yourself. Mr. Mottel, please, and then Mr. Haverland.
Good morning. So it's encouraging to see that the new CMB forecast has converged very closely to our city baseline scenario. Perhaps maybe probably most notable difference is the timing of the beginning of the easing cycle, because based on your forecast, it seems like that your first cut is at the end of 2028, whereas our baseline scenario assume the beginning of 2028. So my question is, what are the, I would say, forces in the model which are holding still elevated policy rate even throughout almost the whole year of 2028, when at the beginning of 2029 and further probably we can expect some moderation in the prices, especially also driven by this negative base effect of this ETS2 implementation in 2028, and especially from the perspective of long run, I would say, model gravitational pull towards the 3% neutral rate in the nominal terms. The second question is, I see that also your new forecast incorporates additional hike in case of ECB in the third quarter this year, which usually was followed also in June by a rate hike in case of CMB, but this time it seems like it's not expected to be followed by CMB in third quarter. So if you can elaborate more how CMB bank board members thinks about this monetary policy of ECB, because based on some previous communication, it seems like that some members are putting more weight of the ECB rate. Some of them are just taking it as one of many other inputs to the forecasting process. So this is the second question: what's the role in the monetary policy decision process in majority of the bank board members? And the last question, just technical questions. As Jakub said, that you implemented the impact of ETS2 at the beginning of 2028. When we compare it with the baseline scenario 1 year ago, you assumed with larger impacts to the upside in prices. I think it was primary impact was 0.44 percentage point, and the second round effects was 0.15 percentage point. But this assumption was consistent at the time with the price of emission allowance at 29 euros. But now the contract with delivery at the end of December 2028 is trading around 67 euros. So my question is, if you lowered this impact or the transmission channel from this ETS2 to the domestic inflation, or you just leave it as the same, but you are assuming probably some government intervention to offset some part of this price increase? So thanks.
Maybe I'll start with the last one, and if I can, that we did not change much the quantification. We still work with this assumption that the effect would be diluted by some other measures being taken by the government, and therefore in the forecast we still assume this primary effect 0.4 and secondary 0.2, but to this secondary effect 0.2 the monetary policy reacts, and on the monetary policy horizon therefore we don't see deviation of headline inflation by more than these 4 percentage points, which are not subject to monetary policy reaction. So we still stick with those numbers which you have cited. We don't think we have like solid new information which would be a good argument to deviate from that. Then what are the factors? Then I'm skipping to the first question, and maybe the second one is more on the board member. What are the factors keeping rates above 3% in 28? This is how I understand. One of the reasons is what we already mentioned, the ETS2, that we have shock which we anticipate, which is 0.2 in inflation. So this is one item which the monetary policy needs to react in advance to this. So this is one factor. Then we still see elevated wage growth, which also the impulse response of rates to wage growth is a very prolonged one. The labor market pressures is something which stays for longer. So this is another factor which has long-lasting effects, the labor market tightness, which we still perceive to be the case, especially looking at the wage data. And overall, the cyclical position of the economy, we see GDP growing quite strong in the next year. Domestic demand being also relatively robust, also with the wage growth keeping it afloat. So all these factors, and also the ECB outlook. I think I believe it stays above 2%. The pricing for the ECB rates going forward. So this is another factor from the interest rate parity, which keeps us above our long-term neutral.
Okay, the second question was about the ECB hike. So in our forecast, our expert from the monetary policy section assumed that there will be one hike in the next 12 months. So it's included in the forecast, but frankly, there was no discussion yesterday about the next ECB steps. So market expectations changed. So we will follow the next decision and decide about the next steps meeting after meeting. So there was no discussion yesterday.
So, Mr. Haveland, please.
Good morning, ladies and gentlemen. David Haveland from ING. My first question is about the exchange rate, and it seems to me that the CNB pencils in repeatedly weaker koruna against the euro in the medium term. And my view is that kind of it's systematically biased and we receive actually stronger koruna in the end. So whether this is not a good candidate for some kind of adjustment in the model or in the forecasting process, and we might end up with lower imported inflation after all. The second question is about, indeed, again, a bit the ECB hike suddenly in the June decision became one of the main points of reasoning. And the CNB repeatedly tries to position themselves as not being a follower. But suddenly it came strongly, repeatedly, we will see what ECB is doing. And my question is, what has changed, if anything? And second, is maybe the ECB's rate not too strongly kind of embedded with respect to impact on rates and other variables in the model, so that even the model supports this idea of following ECB? And the third question is, we have, I believe, plenty of risks ahead for real economic activity performance. So at the end, we may see softer expansion this year and possibly in the next year. And my question is, what would be kind of the, let's say, risk threshold for GDP lower growth rate for penciling in weaker rates trajectory and for considering kind of more relaxed monetary policy? Where is the pain threshold for you? Thank you.
Maybe I will start. So the main reason of the June hike was domestic demand or domestic reason, domestic inflation pressure, not ECB decision. So the first of all. So we are following the ECB, of course, very closely, but now our main concern is the persistence of core inflation and like other reasons, especially domestic ones. So we still follow ECB and also international geopolitical tensions and like many other factors, but it is not, our main focus is now on domestic part of the whole issue.
It's always difficult to forecast the development of exchange rate. I guess it was Alan Greenspan who said that the successful rate of Fed forecasting exchange rate is smaller than tossing the coin. So now I'm aware about the problem with forecasting of the exchange rate. But in our exchange rate forecast, we expect roughly stability of exchange rate of the koruna against the euro. I think it's roughly reflects the situation we faced for last year almost. We don't see any strong evidence for significant change of the trend of the exchange rate currently. What we can see is mild deterioration of balance of payments. So it can create some pressure on a weaker koruna, as well as the outflow of the capital from the Czech economy. Is the main investment of Czech households and companies abroad. It's not about the outflow of the foreign capital. So in this combination, we can see some mix of the further stability of exchange rate with some factors which could, in some situation, create some pressure on slightly weaker koruna. But overall, the picture is we expect the stability of the exchange rate. So the exchange rate should not produce any additional inflation pressure or significantly reduce the inflation pressure in the economy in coming quarters. And in terms of softer economic activity, I think it was at the first slide that in terms of GDP, we definitely can read lower growth of GDP. But in terms of domestic demand, we can see that the domestic demand keep growing at a solid pace. There was no significant slowdown. So in terms of our forecast, we don't try to target the GDP. It's all the time about the inflation. So there is no threshold for GDP growth. The only threshold is for inflation. And we don't see that this type of weaker GDP growth so far has not bring any significant slowdown or slowdown pressure for inflation. Core inflation currently this year is stubbornly close to 3%, inflation in services 4.5%. So that's the main reason why we see that it's responsible or wise to remain cautious and patient with the development of monetary conditions and the inflation.
Maybe I will add a detail to that. That's the GDP growth being relatively the headline numbers being relatively weak is a little bit at odds with some other indicators from the economy. We see industrial activity at, on average 1.9 since the start of this year-to-date annual growth rate. Retail sales 3.3 year-to-date average growth rate. Sales in services 2.4 average year-to-date growth rate as released today. So these numbers are relatively strong. I mean, this is a nice growth. So we see the risk of like sudden, I don't know, stagnation of economy or prolonged stagnation as being relatively low now.
And in terms of softening the growth, we as well can see the strong rebound in bank loans or in credit, as well some loosening of fiscal policy in Czech Republic and as well in other countries in Europe. So still it creates some factors supporting the growth in coming years. But we are aware that there are as well the risk on the other side is the higher energy prices and as well the impact of problem with supply chains as well.
If I may briefly react. I mean, the Czech economy is not the US economy, and we have got many fundamental reasons to believe that the corona will strengthen. And even the fundamental change when now the Czech firms are heavily investing in Europe will mean kind of that they will receive European kind of profit and will kind of turn it into coronas. So even this is another reason why to change kind of your, in my view, consistently biased exchange rate forecast. So I believe this is not kind of comparable to the US situation. And second, for sure, GDP is not targeted, but I assume weaker GDP would mean weaker household consumption and at the end, lower pressure on prices, lower profitability, kind of lower ability to increase end prices. So do you discuss maybe some kind of pain threshold where you think this is too weak? No. Thank you. Thanks for your answers.
So, Mr. Rusinko.
Good morning, everyone. Dominic Rusinko from ČSOB Patria. I have one question related to wage growth. Thank you very much for that slide. So my understanding is that there is some maybe unusual noise in Q1 data, that high headline growth. My question is that if we get that noise also in Q2 data, which will be released in early September, and one question to Bank Board is whether this is downplaying price pressure stemming from the labor market, because the headline figure apparently is not reflecting, fundamental strength of wage pressure, particularly not into the extent that you saw in a headline figure. So how does it change the assessment of the overall wage pressures that are currently being in the Czech economy?
I'll start with the Q2. We expect 7.3. You can see it from our tables. So we still think that this distortion, or how we can call it, will stay there. Also, like in the next 4 quarters, until the number is revised again, and then we might in the future learn that the growth has been lower, like these numbers which we are seeing now.
Okay, again, as you said, there are numbers of technical factors in the play, and we had a lot of discussion about the wage growth and labor market in general, because it's even like more complicated than without these technical factors. We know that official wage growth may appear like too high now, but still the labor market is perceived as tight and generating inflation pressures, especially in the service market. So this point of view haven't changed with this new data. So we agreed on this fact.
Okay, so Mr. Schindler.
Thank you for the presentation and so far the answers. I have questions about what are the main drivers of the weaker core CPI growth in future if you assume the stronger GDP growth? Simply just explain us what is the main driver, because in 2028 probably there is some model return to the steady state is already in place. So which factors you see now? What is going to change the core CPI trajectory, which has been so far quite sticky? This is the first one. And the second one, we discussed the euro check, but isn't as a part of the model, but it can be the monetary policy tool. So how do you perceive the strength of the currency? Whether we can make the currency a bit stronger simply to support the disinflation in the core? So if you think about that, because you are doing some regular sales from the income from the FX reserves, which haven't been changed for several years already. So we will discuss also in this way. Thank you.
Yeah, on the core slowdown, I can say, from the modeling forecasting perspective, it is the tight monetary conditions and strict monetary policy which contributes to further reduction in margins and core price pressures. But like focusing on the sub items, we see a candidate in the imputed rent where the contribution of imputed rent has been quite high in recent years, following the double-digit growth rate of new dwellings prices, which we know there are some leading indicators which point to a deceleration in the dynamics, that in the second quarter of this year, big part of the dynamics is dying out. And despite we see growth in construction materials, and maybe we'll see a acceleration in construction works prices, then this can balance out somehow with the deceleration of the prices of new dwellings, and this can be a contributing factor that core inflation comes down with the help of restrictive monetary policy.
In terms of economic story, we can say that it's the slowdown in wages, but again, this combination is also really a reaction to the tighter monetary conditions. Yeah.
Okay, so Mr. Pohol.
So Martin Pohol, General Investments. I had also a question related to core inflation. It was raised by Mr. Schindler. So maybe one follow-up small question. Your assumption about household energy prices over our forecast next year. And also one follow-up question related to wages is rather technical. Maybe if you could dive deeper into the explanation, what's behind the, let's say, the persistent overestimate of wage growth by the statistical office, because it has to be some interpretation, whether it's the sample, whether there's some model that calculates the sample. And also with such a large revision of the past, I would expect that also something change, also some other changes. You cannot reduce, let's say, wage growth without affecting other variables in the economy. So is there some broader story behind the quite significant revision?
Yeah, it was. I was shown in our forecast in inflation. We expect the change in the dynamics of energy prices for households, and it's in the row administrative prices. This year, the electricity prices and gas prices for households, one of the factors which helps to reduce the inflation. Next year, we expect that this effect gradually fading away, and these energy prices will contribute to the higher inflation. In terms of administrative prices, we expect that the growth around 2.5%. Is it sufficient? Yeah. So we expect that at the beginning of the next year, and this is one of the, I would say, factor of higher energy prices. It's for the next year. Probably we don't see this more about too much about the crude oil prices, but about the gas prices for the households for the next year.
Yes.
As inflation factor.
If you would ask us about our perceived risks and our perceived risk factors, it would be the natural gas prices for households in next year or two. We have this this system of very slow but persistent pass-through of energy prices, natural gas to consumer prices. So we see now natural gas prices not correcting that much as the Brent price, or not following all the way down back to the like early this year, but staying elevated around 55-60 euro per megawatt hour. We see the gas storage being relatively low, and the need to fill these gas storages for these higher prices. So we see the natural gas as being more serious risk to the future price development. Another risk would be the food prices now, where we have the relatively strong disinflation now, which we shouldn't expect going forward. Seeing the not only the price commodities, but the relatively weak harvest domestically, the El Nino, maybe the fertilizers being stuck in the Hormuz Strait, and these factors would contribute to acceleration of food prices, and it's uncertain to what extent the acceleration would be strong, or to what extent it will complicate fulfillment of inflation target.
And in terms of wages or statistics of wages, in this term we are the same. I was a user, consumer of statistics as you, so we can have some hypotheses, but definitely I cannot comment this at this place. It's a mainly question on a statistical office, but what's the reason behind? We can only show you what we found out, what's the behind the revision, but that's all.
Mr. Schindel?
If I just can follow up what we have where we have finished, but it means that we have enjoyed probably weaker wage dynamics in the economy, but still we have enjoyed also still sticky core CPI. So what is the impact or implication for the model? How do you read, all these markups, margins, whatever you have in the model? Have you changed thinking about this? Because this has the impact.
I would say that even if the underlying growth of wages was not 8, but it was 7, it's still high. And it's still consistent with seeing core inflation at 3%. So I show this to tell you that we are not alarmed by the first quarter in wages, but we are still concerned.
So yes, please.
Kubelková, Moody's. Taking like 10,000 feet view of the numbers and the forecast, in one way, it really resembles the US economy. And the question, I think, backs itself. Is the modeling team, but also the board members, are you considering that the neutral rate is actually higher than our long-running assumption of 3%? Because we have been at 3.5 for quite a while, and it doesn't seem that this extra 50 basis points above neutral was really reflected in the data. And in the similar rate, there is a discussion in the US that probably the neutral is now higher than it was. I wonder if that's a discussion also inside of this building.
Okay, so there was no discussion on the bank board yesterday about this fact. So we haven't discussed it for a longer period of time. We, I guess a year ago, there was a huge discussion about the level of the neutral rate that we conclude for a while somehow. But since then, there was no change in our assumptions in this point.
I would say that it's an unobserved thing. I think a year ago or a year and something, I had here a slide on our range of estimates for R star ranging from 2.75 to 3.5. So I would say that still roughly holds, and we need to look at the economy as a whole and to judge if our policy is having the desired effect on the economy, and then ask what the correct response is.
So, Mr. Mincic.
Czech Chamber of Commerce. Dear Madam, dear colleagues, thank for the interesting presentation. I would like to ask about specific instrument that influences the interest rates and fees of commercial banks, as well as the exchange rate. What's the bank board stance on minimum required reserves? I am referring to the rate imposed on them and or the remuneration. Thank you so much.
We made the decision again a year ago about the minimal.
It wasn't.
Yeah, but there wasn't any debate about that for more than a year at the board about the role of the minimum required reserves. So it's we're not using it as a tool, not even discuss it internally. So.
I can only add that our forecast is prepared with the sense that the main tool of Czech Central Bank, Czech National Bank, is interest rates, short-term interest rates.
So, any other question? So it looks that's all. So thank you for coming. Many thanks to our speakers, and see you again in November. Okay, goodbye.